Hi there, my name is Salesh Chand. I'm a chartered accountant in public practice. Today we'll be presenting on how to basically create an investment portfolio for yourself. Format of the day, it's pretty casual, so you can type in your questions. I'll answer them while we're presenting, or we'll stay around towards later in the presentation and answer them for you. Now, we're quite easy guys to work with, so feel free to put your hands up and put your questions in, and we'll stop the presentation and help you through it. Um, so basically, I've just a quick overview of me. I'm a chartered accountant in public practice. I'm an active property investor. I'm a partner here at GRA, and I currently have just over 17 years of experience in property investing and business accounting as well. Currently, in our whole portfolio, we have 51 properties that are our hold. These are our whole properties that are rented with massive land at the back, or it's our cash flow investments. We're also building 70 new houses at the moment, so that's under construction at the moment. It's going pretty well, and we are looking at trading some of these properties and holding on to the rest. Just a quick overview of where things have started. So, in our portfolio, as I've mentioned, we've got over 51 properties, and we got our hold properties as well. So, just an overview of where I started back in 2007. I started with 47 grand worth of debt. In 2010, I got into my first property investment, and 2024. We've got 25. We've got over $45 million in property investments at the moment. Now, again, just a quick overview of this. I'm a firm believer of property investing. I'm a firm believer in buying properties for long-term investment purposes. So you buy properties, rent them out, use the capital gains, refinance, and buy more properties as you go. And I will show you some of an example of what I do. Now, before I proceed any further, I just want to make it clear that I'm not a financial advisor. I'm a chartered accountant by public practice. So I just want you to have a quick look at this disclaimer. I cannot give you any financial advice. Not allowed to. So just a quick market update. This is something that I like one of the economists in the market, and you can't do a presentation without giving a quick market update. I follow Gerard Kerr a lot. He's a Kiwi bank economist, and back in the days when he started as an economist, I got pretty close to him, so I used to get all the information from him. And recently he wrote an article, so this is some of the points he had. The Reserve Bank is cutting interest rates, and they're cutting it quite aggressively. There's firm belief that there'll be more aggressive cuts coming in, especially with the economy being in recession. So we could probably see OCR drop below 2%, possibly to 1.5% over the next 12 months. Now, that's great news for us. This could mean that interest rates could be in the high threes or early fours, and some of the economists are already saying that the interest rates could be in the mid threes. So this is cheap money. And I reckon cheap money will stay in the market for a long time. When I say long time, about 5 to 7 years. So when cheap money comes in, property prices go up. Now, adding to this is the banks are easing on how they're lending money. They're taking their red tapes away, and they're wanting people to get into property investing. With cheaper interest rate, easy finance, property prices will go up long term. It's going to happen, and properties will start selling. Now, the biggest thing that we are noticing in the market with the national government is they are turning the immigration tap on. They want people to move into this country, which is fantastic. And once we have more and more people move into the country, there'll be another lot of demand for houses, and prices will slowly go up. Now, we think prices will go up over the next 2 years, and Gerard Kerr, he thinks the same thing as well, which is fantastic. I think we'll probably see 5 to 7% growth over the next 24 months. I know that some of the properties are selling really well at auction. Some properties are not. So the market is changing. So if you are looking at getting into property investment, now is the time to get into property investing because we are coming out of the bottom now. So if you can get in there, negotiate a good property, and get into property investing, why not? I personally started property investing in 2010 as my first investment. This is when the market was right at the bottom. You couldn't get funding. You couldn't get a loan for $300,000 to buy a house with 1,000 square meter land. That's how bad the market was. And that's how I got into property investing. Is right at the bottom of the market, bought properties and waited a few years. Capital growth came in. I refinanced or sold some properties to release some equity, and that's how I grew my portfolio. But if you're a first-time investor, or you are experienced investor, or you own a family home, or even business loan, I'm telling you, there's some cheap rates coming. Watch out for over the next 12 to 24 months. There's some cheap rate coming, and if you are looking at fixing your interest rate, as the bankers are saying, most people are only fixing between 6 to 12 months because everyone's anticipating there'll be cheaper interest rates around. Um, and my last point there, credit demand and supply improving. Banks are lending again. The banks are opening up doors and they're lending funds out at the moment aggressively. So I think as the year passes down, going to 2026, it'll be much easier to borrow money. So if you are a property investor or you want to be a property investor, get yourself sorted and get into some property investing strategies now. And I'll tell you what you need to do in a sec. Now, I've also got Then and Maggie joining me later in the presentation, and they are active investors, so they invest every day. They also do have trading activities specialists, so they buy and sell houses, do them up. They can help you with market value assessments. They can do renovation and stuff like that. So basically, they do everything. They're project managers. Um, Then and Maggie helped me a lot. I talk to them literally every day about property investments or what work needs to be done. So we talk a lot and we talk about development sites. We talk about client portfolios, what clients need to buy, what they don't need to buy. You'd be surprised the amount of no's we do with clients that are wanting to buy properties, and we go, no, don't buy that, don't buy that. So we help clients with that. So Then and Maggie, if you are looking to get into properties or you are experienced property investor, you need a second opinion. Then and Maggie is your go-to people here. Now, in case you don't know who GRA is, what we do. So GRA is a chartered accounting firm in Newmarket. So, we do a lot of things here. We do property investments and education. So we teach you how to invest in properties and what you need to watch out for. So that's one of our main businesses, property advisory and education. We do asset planning. This is where we come up with structures to help you protect your assets. If you've got a business, we teach you how to protect your business and come up with ways to do that. Or we look at your family home, you look at your rental properties, and we safeguard them from any potential creditors. That's what asset planning is about, protecting your assets. Now, we also do tax advisory work. This is where basically we work out how to minimize your tax. If you've got GST issues, you've got international tax issues, we give you a hand with that. We do a lot of that kind of work as well. Now, as one of our biggest businesses, business advisory services, this is where we do your compliance accounting work. We get your books done, we do your tax returns, we do your provisional tax, and we also negotiate with the IRD. If you are having issues, we obviously get in there and negotiate with the IRD for a settlement. If you are a client of GRE, you'll get access to our insurance brokers. So this is basically our landlord insurance, or your rental property insurance, or your family home insurance. Will give you access to health insurance and any other health cover that you need. So that's being part of GRA. That's what you get access to. Now, the biggest thing being part of GRA is we give you access to mortgage brokers. Now, you need mortgage brokers. If you're a first-time investor or you're a regular investor, you need mortgage brokers on your side because they go out and get you finances. They get you good interest rates. They can refinance you from one bank to another bank, or they can finance you from a second tier to a first tier lender. So it's really important you have a good broker on your side. So being part of GRA or becoming a client of GRA, you get access to all these resources. And basically, you get access to all of them as a referral from GRA, which is fantastic. We've obviously these are not our new suppliers. They've been working with us for over 20 years. We know how they work. They know how we work. We know exactly what our clients need, and we deliver the service accordingly. So why should you start investing in property? Like why? No, why am I sitting here telling you to get into property investments and all of that? I'll tell you why. The main thing is why you should do property investing is freedom. You want freedom in your life. You want to choose what you get to do, right? And the only people who get to do that are the people with massive portfolio investments. They have passive income. As they have passive income, they can do lifestyle choice. They can decide to only work 3 days a week or 4 days a week. That's what they can choose. Or they might decide not to go to work at all because they have a portfolio that gives them passive income. They don't need to go to work to make the income. Now, personal wealth as well. When you do property investing, you create personal wealth. So your asset base goes up. I just showed you where I was In 2007, I was negative 47 in loan. And this is 2025. We got over $45 million in assets, currently in our portfolio. And that's growing every day. We're growing our portfolio every day. So that's what property investing does. It gives you personal wealth. And it also gives you intergenerational wealth. What it allows you to do is pass your wealth down to your kids, educate your kids and to your grandkids, teach them about money. So what happens is when they start working, they know exactly where to put their extra income. They'll put it into investments and safeguard it. I'm a big firm believer of property investing. The reason is I like control. And with property investing, I get to control. Whereas with other investments, you rely on other people to control your investments. With property investing, you get to rely who you choose as your tenants, what rent you get, who you bank with, and all of that. So that's why I like property investing. But those are the beauty of doing property investing. You get freedom, passive income, lifestyle choice, personal wealth, and intergenerational wealth. They can't get any better than that. Now, let's say you're not a property investor and you decide to save money. So, in this particular case, let's say you're 45 years old. Your target is to save $2 million over 20 years, right? So, that means you need to save $100,000 each year to end up with $2 million. So, you basically would need to earn $250,000. You can see here salary of 250, pay PAYE of 74,000, use 76,000 to live on. That's your mortgage, petrol, traveling expense, everything, food, and then you're left with 100,000 savings. Now, everyone out there knows it's impossible to save 100 grand a year at even 200 grand, 250 grand salary. As you earn more money, you end up spending more. It's just human nature, right? So if you're earning 250 grand, I can tell you you'll be spending 250 grand a year on your lifestyle and the savings will be next to nothing. Let's say you are a good saver and you end up saving $100,000 a year. And if you do save $100,000 a year, I can tell you in the fourth year, you'll start feeling you're sorry for yourself. You'll buy yourself a car or go on a nice expensive holiday. This is what humans do. So as soon as they can see money in the bank account, they'll use it. Personally, I'm one of those guys. If I see money in the bank account, I'll use it. I rather invest in properties. So why start now? Like some people must be going, well, why should we start into property investing now? What is it? Well, most people need long term, to build their passive rental portfolio. So you need a long term growth strategy. Now, when we say long term, between 7 to 10 years, we think you can build a perfect property portfolio that can give you passive income with massive equity, right? And we'll show you in a sec how to do that. Property investing is long-term games rather than short-term. That's really important to understand. And currently, it's a buyer's market. It will change. It will definitely change. And I reckon it will change in the next 24 months. You will see the market changing. So now is the time to actually get in there and start negotiating some good deals. And now is the time to actually buy properties as well. Generally, value goes up, so I don't think properties will be any cheaper in the future, especially the cost of building houses. I'm building houses, like I said, every day, and the cost of building houses is just going through the roof. There's no such thing as cheap labor, cheap materials. They don't exist. There's no cheap land available in Auckland. I build in Auckland, and I'm going to start building in Rotorua. There's no cheap land available anymore. And what we see long term is there'll be a shortage of rental property, and we basically will see economy recovery. And that's going to happen because you can see the government's making changes. Immigration, they're turning the tap on immigration, and they're going to come in numbers, and we're going to have international students come in as well. That's going to put pressure on housing. And also, as more tourists are coming in, more properties are being used for Airbnb. And the more the government is advertising NZ around the world, we're seeing a large number of tourists come into NZ. So long term, we see property prices going up. We see shortage of rental properties happening. And don't forget interest rates coming down. So designing a property strategy, like what is it that you will they need to design that will help you achieve your retirement goals. So basically, you look at passive investment. Passive investment is designing a portfolio that you can retire on. For example, you might say, I want $5,000 a week surplus income after all the expenses are paid. So that's what we refer to as passive investing. If you accumulate the right properties at the right price, you will have passive investing or passive income coming in. And when you have enough properties, you don't need to work, or you can choose to work certain days. And if you do passive investing correctly, I can tell you this, and I can assure you this. within 7 to 10 years, you will have an amazing portfolio that you can retire on. When I say within 7 to 10 years, buying the right properties at the right price, buying discounted properties, buying cash flow properties, buying properties with multi-income dwellings. And I'm going to show you the kind of properties I buy. And if you do, long term, these are your quality investments. It goes up in value. It leads to wealth growth, and it creates intergenerational wealth. As I said earlier, that's what I like about property investing. Creates wealth for you and creates wealth for the family. Now, some of the strategies that I'm going to recommend to you. So feel free to take a photo of this slide. This is really important, and I basically use this every day for myself. This is my strategies. Number one is the property cash flow positive. I need to ensure properties are cash flow positive because I'm not interested in topping up the mortgages. I want the properties to do well. I want them to go up in value. I want the property to fund itself without me putting money in. I like multi-income properties, and I'm going to show you what multi-income properties are. Because for another 100 or 200 grand, you could buy another property or another site with a couple of dwellings on it. And those things are good because you get extra income straight away. Capital growth, I like buying properties for discounted. I get instant capital and capital growth, and I get instant equity. So capital growth and instant equity is very important in terms of growing your wealth. Land banking assets, I do chase land banking assets, but I only chase land banking asset that has income potential on it already. So has an existing dwelling or a couple of dwellings on it, because that allows cash flow to come in while I'm deciding what to do with the land banking assets. And you can do development sites as well. Development sites are basically, I would say you only want to do that if you're experienced a property investor or you've got a lot of funding behind you, because developments can be quite expensive. A standard development in Auckland, if you're doing 5 lot development on 1,000 square meter site, that could be about 4.1, 4.2 million from start to land. So that's a lot of money to come up with. So I'm only recommending to do development if you have the money or if you have the income behind you to support your development. Now, here's an example of cash flow investing properties. Now, this is a property that we bought a couple of years ago. We bought it in Rotorua. We paid $515,000. We spent about $35,000 on renovation. The total cost was $550. The market value came back at $850. So instantly we created an equity of 35% or 300 grand. Now, if you look at the property, it's got a front dwelling and it's got a back dwelling as well. And in front, it's got a little 1 bedroom unit as well. So you got 3 sources of income on this property. And we paid 515, total cost 550. Straight away, it rented for $1,300 a week. 5 years ago or 3 years ago, it rented for that at $67,000 a year. Our insurance operating expenses, once you take that out, we are banking $56,000 a year in income before interest expense. Now, at that time, the property was geared at 70%. So we go minus our interest cost. It was doing $800 a week positive, right? So we fixed this loan at 4% at the time. So at $800 a week positive, what we did with the cash, we got that every week. We started hammering our debt down. So we've been paying our debt off. Every time we get positive surplus out of properties, we use the cash to pay off our debt. Now, I would buy 50 of these sites. If I can buy 50 of this, I'll buy them, if I can find them. And I can tell you this now, I see my clients, I see some of my friends and families finding sites like this every week. Someone's offloading for whatever reason, someone else is buying it. So when you're out there looking for this kind of sites, you hunt them. So this is an example of my cash flow positive investing property. It's got a couple of dwellings in there, so front and back, and a little dwelling, and it's got 1,000 square meter land. So I've got cash flow, I've got land banking on this particular property, and I've got instant equity. This is this kind of stuff I buy, and I chase them every day, and it creates wealth for me. I never want to sell this kind of assets. Once I buy them, I want to hold on to them. Now, here's a property I did in 2010. And the reason I want to show you what I did in 2010 is because I do exactly that to date. So this is a property I bought in 2000 for 320,000. I renovated the front house and then I built a second dwelling at the back. So it cost me 290. Total cost was 610. The market value at that time came back around 1.6. Doesn't matter, I could sell it or not. It allowed me to instantly refinance and use my equity. So I got 990 as the instant equity. So what I've done, I refinanced and I used the money to buy other properties. That's what I did back then. Anyway, currently the property is rented for $1,600 a week. Sorry, I haven't updated my number there. So it's rented for about $80,000 a year. Operating expenses similar, about 7,500. I bank about close to 60 grand on this property as cash flow positive a year. Now, I'll tell you this now. This property is done so well, it's paid itself off. So I don't have any mortgage on this property left. Because when the interest rates were 2.9%, I fixed the interest rate and I kept hammering the mortgage down. I kept paying the mortgage off with all the surplus income. So currently the property is debt free and I get that basically $80,000 a year rent in my pocket. So it works. I did it in 2010. 15 years later, this property is fully paid off. It's got an extra dwelling and it's giving me cash flow every week. I get the money back into my bank account. So this is the beauty of doing cash flow positive investing. Here's another place that I did a couple of years ago. I bought it for $707,000. Renovation cost was 40 grand and settlement cost was about 2 grand. So total cost was 749. The market value came back 1.1. We released 351,000 instant equity we could use. The property is rented for $1,100 a week, $57,000 a year. So it's got a front and rear dwelling. So what did I say? Multi-income dwellings. Here we go. I got two multi-incomes coming in. After paying all the operating expense, we end up with $52,000. We're 70% geared on this property. So we paid $26,000 a year interest. We left with 24 grand. And what do we do with the 24,000? We keep paying off our debt down. That's what we do. And so this was a recent example. We did this a couple of years ago. I chase multi-dwelling properties and my clients do the same now. And so it works. It definitely works. Now, I can tell you this. I've helped a lot of clients over the years grow their portfolios over the last 18 years. And I can tell you this, 95% of my client base are multimillionaires because they invest in properties. They realize it's a long-term game. They chase cash flow. They chase land banking. They chase discounted properties. And there's no other ingredient to our investing. This is the kind of properties we chase. Here's a property that we finished recently. It's in the last 6 months we did this. We bought this property in Rotorua for $310,000 in a very good street. It needed a lot of work. 150 grand was spent on renovation. Our total cost was 460,000. After reno value came at 700 grand. So after renovation, the value came at $700,000. And we basically gained equity of $240,000 in 3 months. Refinance at 490, so we got all our money back. All the money we've put into this property, we got it back. So basically, we got this property for free, right? So basically, we reinvest all our money, plus we got extra 30 grand back. Current rent is $45,500 per year. That's what we're getting as our current rent. 23,000 interest plus 10 grand OPEX is $10,000 a year surplus. So not only we got all our money back, the property is giving us 10 grand a year back, and all we're doing is using the money to pay off debt. So this is the property we did in Rotorua and Lee Road. It's a fantastic asset. Now currently I've got architects on it. We're looking at building a couple of more dwellings at the back. We're looking at probably 2 more houses at the back because it's such a good area. We're going to build those houses and rent them out. So here you go, guys. I'm not hiding anything today. I'm just telling you what I do in terms of property investing. And this is what you can do with your portfolio. You chase cash flow positive properties. You chase land banking assets. You chase instant equity properties. This is the stuff that you chase. Here's the example of land banking. I'm just only going to show you a couple of examples of land banking because it's a different game ball totally compared to holding properties for investment purposes. Now, if you look at this, we bought the rear side and then we ended up buying the front side. So now we got 2 sides side by side, 1,000 square meters each. So they're 2,000 square meters all up, and it's got a road entrance at the back and in the front as well. So we are looking at building dwellings on this side. So this will be a good side to build on, and it's totally flat, right? But while we're doing land banking, we got houses on this side, and between the 2 houses, they're rented for about $1,300 a week. These 2 houses are rented for $1,300 a week. So we get cash flow coming in. And what we're doing with the cash flow, we're paying all our operating expenses, we're paying the banks, and we're using the surplus to pay off the loan down. Here's another side that we bought side by side. So basically what we've done here is I think they're about 1,000 square meters again, and the rent on this side is about $1,500 a week. They're about $750 each. There's 3 dwellings all up. We rented for. We rented on this side here. So again, long-term plan is to demolish and build houses on the sides. That's what we're aiming to do. And we're hunting this kind of sites every single day. So look at this site again. It's cash flow positive, it's land banking asset, right? And that's what we're doing here. And we got instant equity on these sites as well. Now here's a development site. Again, I'm only going to show you one development site. Here's a site we're building in Theatre South. We're just probably 2 months away from finishing the site. We're building 8 units. The land was 1.35 million. The development and build cost is 2 million. Our total cost is 3.4 million. Our market value is coming at about 5.7 million. So our equity on this side is just over $2 million. And I'm doing this with a couple of my mates. So we've got about $2.3 million equity. Now, we don't need to sell this because we're doing with a couple of mates. We call it syndicate investing. We can just take a couple of dwellings each and we're happy with this. So we don't need to sell this. We'll probably sit on this asset and rent it out. Now, what to avoid? Now, you got to remember that we make mistakes as well in the stuff that we've done, which is cost us money. So avoid gang infested areas. So we tell our clients to avoid those areas because what happens is once you buy properties in that area, you can end up getting rough tenants and they can ruin your property. So avoid those kind of areas. Avoid negative cash flow investments unless you have amazing income. If you're earning a couple of $1 million a year, you can afford $300-400 a week negative cash flow. Go for it, right? But if you can't afford negative cash flow, please do not buy negative cash flow assets because you will go broke. You won't have the money to fund negative cash flow long term. Short term, it'll be fine. Long term, you'll be struggling. Don't buy properties without CCC compliance. The reason is you won't be able to get insurance on these properties. Very important. Go and check your CCC on it. Get the real estate agents to provide you all the details. Properties that you can't get insurance, like leaky buildings, earthquake issues, flood areas, avoid these properties. Or if you are going to buy them, check with the insurance company first before buying these properties. The reason being is if you do buy an asset and you go unconditional, but you can't get insurance on it, you can't draw your mortgage down. Remember, insurance is equally as important as mortgage, right? And to draw your mortgage down, your lawyers need to provide an insurance certificate to the banks to confirm that you have insurance on the property. If you can't get insurance on the property, you cannot draw down on your mortgage. Doesn't matter you have a pre-approval in place. No insurance, cannot draw your mortgage down. And please do not give up your job to become a full-time property trader. It just doesn't work, right? It just doesn't work. It works for certain people, but I'll tell you, it's just such a hard thing to do because what happens when you give up your job, you still got your mortgage payments. You still got to pay for food. You still got to feed your family. You still got to drive your car. You still got to pay for the power bill. So please do not give up your job to become a full-time property trader because that can really, really hurt you. Now, what happens when you do property investments correctly, right? If you go out there and buy the right properties and things like that, what happens? Buying for less than market value, that's instant equity. Very important, guys. You buy, negotiate well and buy it below market value. Keep your properties for long term for capital gain purposes. If you keep your properties long term, you will definitely get capital gain on it. Now, if you don't believe in this, go and read Bob Jones' book. He's the firm believer of capital gain, and I believe in everything he said about capital gain. Long term, you get capital gain. On average of 10 years, your properties do go up in value, and you do really well. So, think about long term here. Renting or leasing for rental income, that's passive income. Once you buy a rental property, you can lease it for passive income purposes. Now, you can also do, if you do improvements, repairs, or renovation to the building, it adds value. If you do it properly, you do it within your budget, you can refinance the property and add equity to your property. So this is important. This is why property investing helps you grow your portfolio. Now, there's two types of investing, passive and active. All the time I was talking to you about was passive investing, where you buy properties, rent them out, and receive passive properties. Now I'm going to talk about active investment. Active investment is where basically you renovate worn out properties and you sell these properties for profit. You fix houses with issues like unconsented works. They might have put a window somewhere, or there's a carport that shouldn't be there, or drainage issues. So what you do is you can negotiate well, buy the properties and fix the issues. Reclare leaky houses and sell them. Now you got to be careful. Not everyone can do leaky properties. You got to really understand what you're doing. So mostly reclaims are done by builders or tradies who understand leaky buildings. And you can do rebuild rundown houses. That's another way of doing it. So if the house is really run down, you can renovate and rebuild the house, or you can just demolish and build new ones on site. And what do you do with profits from your active investing? Helps you grow your portfolio. If you make say 150,000 dollars a year, you can grow your portfolio on in terms of active investment. It gives you surplus income. Now, here's an example of a property that we did a trade a couple of years ago. We bought this property for 1.37 million. Our projecting selling price was 1.8 million. I think that's what we ended up selling it for. We renovated the property, and there was a marketing and holding cost and interest cost. It took us 6 months. By the time we bought the property, subdivided the property, and sold them separately. So we bought the two houses, we subdivided and sold them separately. Our total cost was 1.495 million. Our profit before tax was $314,000. Once we paid GST, we ended up with a profit of $267,000. That was our profit. Um, so that's not a bad profit, guys. And we hunt for deals like this as well. They're not easy to come by, but they do come by. So it's important to watch out where you can buy a property, either renovate it or subdivide and not sell it for profit. Now, guys, if you do want an initial meeting with one of us, I mean, we're going to have Maggie and Then talking shortly. Please feel free to obviously scan that QR code, and you'll come across a form you can fill out, and we'll get Amy to call you and book you for a meeting, or you can just call Amy directly. Here's her contact details, and she'll be able to book a meeting with you. Now, guys, remember, basically our initial meeting, they usually cost clients 500 plus GST an hour. So we're doing it for free if you're non-GRA clients. Now, I will offer you something today because I like to give something away for free now and then. And I'm in the mood today to give something away. If you do fill out our form, I will draw Property School tomorrow, which is one of our courses. And I will give someone a free access to Property School for 1 year. I'll do that. And even if you do fill out a form, you don't win any present, we'll send you a free book. I want you to understand about property investing. This is why I sit here and talk about property investing, because I like to grow people and their wealth. And that's what I've done over the last 18 years. Basically, me, GRA, Maggie, and Then, we helped a lot of clients over the years grow their portfolio. So, guys, yeah, if you do need a meeting with one of us, please email Amy, or you click on that QR code, and then we'll do a draw tomorrow and give someone free property school, or we'll give you free book as well. Now we got Then coming on. I'm going to step aside for a little bit while Then takes over. Then, you there?
Yeah, I'm here. I'm just adjusting my camera.
No, all right.
Well, Salesh, that's a lot of information, just sitting here listening, and I'm sure the people there that's listening in took all that information, and it is a lot to take. And when I started off, with property, I had to attend different seminars and to get my, head around the terminology and how property works, the business of property. While I'm getting the slides, what I want to do is just wanted to let you guys know how I started. I mean, with property, for me, you know, coming to the country, I didn't know how property worked. My going through school, going to tertiary, started having a full-time job. I worked 9 to 5, got promotions in my, the work that I worked in, and I was a sales rep, earning about 80K in salary. But the thing is, the realization is as I got older is like I've got nothing behind my name for when it comes to with property. And if something happened to myself, there's nothing. I probably have to, go on the benefit or ACC, and that's not going to help me much. But so the research started going, what is there? What can I do in New Zealand in order to build something for the future? And property is a common denominator that keep coming. So invested in time, education, and initially I got into in active investing, which Salesh shared, where we bought properties, we added value and sold it for a profit because I didn't have much money other than the fact that at that time when I started, I had 50K worth of saving and access to 130K of a revolving facility from the family. So got into the education, understood how that worked, and then moved into doing my first deal, where in which in 2015 made a 65K profit. It's all well and done having to listen to someone saying, I made this, but to have the money in your bank account was, is a true, eye opener going, wow, this really works. And it makes you hungry. You've done it once, you've seen the success, you want to continue to do better at it. And that's what I did. While working full time, like Salesh says, do not leave your full-time job. I went on to, put a target of one a quarter and make 200K profit. And then from there, I resigned from that job so that I could concentrate more on property hunting and doing more deals. So to give you an overview of, how that, learning how the business of property, I've got into active trading and, got more deals. But today we're talking about building a portfolio for the future in a rental stock. So I'm going to share with you some of the rental properties that I bought and my thought and the process that Salesh shared with you earlier in going through these deals. So now I'm blessed in the sense that, I took the initiative in getting myself educated, surrounding myself with the right people, and then also allowing myself to learn because, every deal that I get being part of, or every transaction, we grow on it. We make mistakes, definitely, but we make sure that we take the learning from that and then not to repeat it. And also, if I made a mistake, I share it with the people that I'm with. Saleh shares it with it, Maggie shares with it, so that we have a network that said, hey, I did that, that didn't work out. So keep an eye for such and such when you're going to buy this property or going before going unconditional. So looking at the long-term side of the property, so this is the first property that I bought after trading is the home and income. So the front property was run down, it needed work, but the back property was perfectly fine. So my thinking then when I bought it was just over 1,040,000. So two properties for 500. So if you look at it, each property will be, if you divide it by two, 520,000. We're in Auckland, and this is in Newland. And would you buy a property, a full house, for 520,000? So the numbers worked. I could rent the property for 600 and have cash flow while I'm living in the front property. At the same time, once I moved in, working with the neighbor, always, your neighbors, you want to be friends with your neighbors because, eventually one day they will sell. If they do, they come knocking on your door and say, hey, would you like to buy? And that's what I did. So I bought the neighboring property and then I've got the eye on the back at the moment. Still, they're not selling yet. So let's see what happens down the track. The family home that's what's there, I had the same mentality when I was looking at buying this property. How can I add value? It was a rundown property, but it had good bones, good character, and so therefore I was able to pick it up for a discounted price, add my add value by doing the improvements, so that I can take the equity out and then recycle into going into the next property. And there's another rental property, number three there, that's in Fawana in South Auckland. The same principle, bought it well at a discount and then put it in for long-term rental. So looking at these property, number one that we saw, so the principle there, we were looking at cash flow, which Salesh mentioned, multi-income property. So we got dual income. Yes, I was living initially on the front and have the rental at the back. But once I move out, I got two rental income property there. We got capital growth, definitely on those two property. Instant equity because I added value by renovating the property in the front, and land banking because as you can see on the bottom, I could build six dwelling in the future, and those are the plans for it. And there's the development opportunity there. So this is the logic or the thinking that I've gone through when looking at my long-term rental. So what I'm doing right now is going through the process that Salesh mentioned as what we always do every day. So, and the other thing here we have is that there's another strategy I could do. I could do the development. That's one. I could sell it as it is. Or you see that blue line there, I could subdivide it into two lot and sell it. But at the moment, I'm not. I'm getting two income, happy with it. It pays itself down, and I can build six houses in the future. Similar principle for the house in for one that I shared. Uh, I got two options, shift and left. So shift the existing house, put it to the back, build a duplex, or demolish it and build three standalone houses there. And both are renting, income is coming through. So the key here that I'm trying to tell everyone is it's possible. Myself, having had no clue what property is all about back in 2015, having not even looked at a sales and purchase agreement, is about getting yourself educated if you don't know and starting and starting and basically is getting around the right people that give you guides and advice. It's not hard, it's not rocket science, it's about knowing the process. And then that's me. So hopefully this was motivate someone to, take action if they haven't. And I'd like to get Maggie in so she could share her story.
I'll just talk a little bit about the strategies that I used and the sort of properties are selected to grow a portfolio and properties selection with a couple of examples. So just going to touch on these briefly, and then of course you can ask any questions afterwards that you like, and we can go into more detail. So I started off learning about property and how to invest well and getting good advice right at the beginning. And I started with a JV partner because I wasn't able to start on my own. So between us, there was one rental property, and thankfully that had the mortgage on that had largely been paid off. So we're able to secure a $300,000 revolving credit facility using the two incomes are both working to base that off. And to get started, we did do a few active trades early on, also a lot of hands-on work and managing the rental properties ourselves to keep the costs down and keeping all that spare money within the portfolios to build up equity rather than letting a property manager profit from it. So, lots of little things, just all focused on building the portfolio up and keeping as much money within it as possible. So over within a few years after starting, the $300,000 revolving credit facility was paid off. So the properties that had been accumulated were 100% financed, and they looked after themselves. So there was sufficient income coming in to pay for all the outgoings, rent and insurance, and pay for things to be repaired and the odd upgrade when it was required. And the rental income grew to $180,000 per year, which actually didn't change our lives at all because it was all going into debt repayment and supporting the portfolio. So rather than being on interest only lending, we were paying down debt almost right from the beginning. Overall, there was just over $8,000 left each year. So above mortgage payments, over paying down debt. So there was enough there to replace a hot water cylinder if it broke down or something like that. But to move forward, we soon realized that actually the property selection was really important. So we did buy a couple that weren't so great, but I'll just run over a couple that were really good. So a house and a granny flat that was purchased for $540. So obviously it's worth a lot more now. We're going back 10 years when we're looking at these examples. Pretty run down, so I spent about $40,000 initially. Later that year, once those initial renovations were finished, we had to wait a little while because there was a fixed term tenancy that had to come to an end before we could get in and get started on it. But later that year, it valued at $850,000. So it's a $270,000 equity gain, which makes a big difference to growing your portfolio and your nest egg moving forward. And that was partly from buying well, partly from the market moving up, partly from carefully chosen renovations and not overspending on them, and partly from significant increase in rental income. So when we purchased, the previous owner was earning $585 per week from that property. But once that existing tenant was out and we'd been able to renovate it and rent the house and the granny flat separately, the rental income jumped to $840. That's a significant increase in 1 year. Over time, obviously, the properties cost more and then the rents grow in a little bit as well. Another good purchase was this large house and a consented sleep out as well. So that's the green roof building you can see here. That was a double garage, and it had, in addition to the 2 car spaces, 2 bedrooms and a bathroom as well. And then the stripy roof here was just a big old shed. It also had some bathroom and kitchen facilities in it, but it wasn't able to be converted to a house because there were some Transpower power lines running over the top of it. So that would have been a good option if it was possible. Could have potentially turned these buildings into 3 dwellings. But as it is, we rented the house and the sleep out to one tenant, let's say large family, for example, that needed 6 bedrooms and 2 bathrooms altogether. And then we're able to rent the big shed out separately, which was always quite popular. For a little while, there was a chap in there that ran his own home gym and trained people out of there. They had boxing bags hanging from the roof. And then there was a car enthusiast in there that did a lot of car renovation work with his friends and private customers. So again, we didn't really spend much money on this property, unlike the previous one, not initially anyway. But it was that major rental increase from 650 that the previous owner was earning to 950 just after buying it that helped increase the value from 620 to 830 without any work being done. So a really good purchase to grow your portfolio and be able to keep growing it. And over time, the rent grew to almost 1,300 per week, but that was based on an eventual renovation of the house. So our progress has always been pretty steady, been busy working and then being quite hands-on. It didn't leave a lot of time for looking for properties or renovating. It's only been a purchase apart from the initial portfolio where in 2015 I purchased 4 properties, it's only ever been a purchase every 2 years. So we grew from the beginning from 1 rental income stream to 7 rental income streams in 2015 with the initial portfolio, then added an extra property in 2017, which had 2 rental income streams off it, and then another one in 2019 with 3 rental income streams, and then 21 started paying down debt. So in order to keep growing, had to take a step back, sell some of the underperformers, but over 10 years, the equity in them had grown, so that let us step back, as I say, but pay down debt and get into a really strong position for another growth phase with good serviceability. So there's a period of time in there that we couldn't borrow any more money because we didn't qualify for loans, but having paid down debt means we're able to grow again and with a much better understanding of what sort of properties to purchase to enable you to keep growing a property portfolio as you move forward. So still managed to achieve quite a lot with only ever having purchased 7 properties on top of the initial one that was owned right at the beginning. Thank you. So 10 years after starting, they couldn't have foreseen this at the time. As I mentioned, we've reduced the portfolio size to pay down debt and looking to achieve that passive income now or soon, rather than just keep all the existing properties and wait another 15 years before the debt was paid down and the passive income kicked in. And by paying down some debt, we can borrow again and then apply those borrowings really smartly to enjoy another growth phase and end up better off. So the equities jumped in a 10-year period from 430 to approximately 4 million. There's now a home, and from 1 rental dwelling, there's now 8. Though of course there was a higher peak before we started to sell down. Rental income grew from 22,000 from that one house up to, from memory, I think it was about 480,000, and then has dropped because we've sold some properties. That's dropped back down to 320. And now I've kept properties with development potential so that we can optimize those and add more dwellings without having to buy more land, which is another good strategy for growing your portfolio. So trying to grow again from now, focusing on getting the most return out of existing properties and utilizing the just over 6,000 square meters that we've got with the home property. I still keep an eye out, or am keeping an eye out again for buying things, but only looking at high yield prospects. So far, they tend to be end of life properties. So again, they might look great on paper, but if you think about potentially very expensive work with properties that are reaching the end of their useful life, then the return and the yield isn't there. And anything that we buy or build now, in my mind, I have a target of repaying the debt on it over 20 years, because any longer than that, and start to feel that I'd be getting too old to enjoy it. Yeah. Yeah, so if anyone has any questions, but otherwise, back to you, Salesh.
No worries. So guys, I'll get Then to hand me over the slides. Then, if you're there, can you give me the slides back? Um, so guys, I think there's some questions there, Maggie. We'll answer some questions has
Sure.
come through. So guys, very important to note there, if you watch what Maggie was explaining, she's basically invested and created this portfolio, initially putting the deposit in, but then she was refinanced and got all her money out. So basically, you've created a portfolio without putting any money in. That's exactly what we chase every day. So, guys, this is why property investing is quite important, and it works long term. And look, 7 to 10 years, you create yourself an amazing portfolio. Now, so you can probably sit there and you're going like, where do I start? What do I do? Firstly, what you got to do is surround yourself with like-minded people. Really important to get people who understand properties, because there's no point going and taking advice from people who don't invest in properties. If you go to a lawyer who doesn't buy investment properties, he's going to be negative. If you go to a lawyer who does property investment, he's going to be positive and will give you ideas. The same thing applies with accountants. If you got an accountant who does property investing, they're going to help you, hold your hand, and tell you what you should be buying. Or they'll analyze the deal with you and say, don't do that. Don't touch the deal. Also, you want a mortgage broker that works for you and helps you, get funding, helps you get across to the banks as well. There's rules for banks, how they operate and how they do things, but mortgage brokers are the ones that put the case in front of the banks and encourage the banks to invest in you. So very important you use a mortgage broker. At GRA, we use Chris Peterson Mortgages. I'm sure most of you are familiar with Chris Peterson. He's a good mortgage broker and he's helped a lot of clients over the years. Also, very important, you get a good insurance provider who understands your properties and understands their property needs to be valued at the right price. We also have our property school. So this is an education school where we basically give you access to a lot of supply chain, a lot of people that you should be using when buying properties. So if you do want to sign up for property school, feel free. We'll send you a link in the sink. And also read Matt's book. They're quite informative. That's over, that's over 30, 40 years of experience in that book. And also we use people from other places in the books as well with different kind of experience, and we describe their investments in there. So definitely read that book. Now, if you do sign up for initial meeting, we're going to send you the book for free. It's not something that we give it to everyone or at every presentation. I do feel a little bit generous today, so I'm giving away. And we'll also do our property school draw tomorrow. Whoever fills out our forms, we'll do a property school draw in the morning. We'll send you an email whoever the winner is. Also very important, decide on your investment. What do you want to invest in? Your retirement goals in relation to your time frame, if you've left it too late, and what you need to buy. Even if you buy 1 to 2 good properties, it will make an impact on your retirement. Because 1 to 2 good properties, you could end up, basically getting, $1,100 to $1,200 a week in rent if it's debt free. Say $200 for operating expense, you end up banking $1,000 a week for yourself. Now, before I jump on this slide, we've had some questions come in, Maggie. I'll try and answer the questions before we jump.
Yeah. So Duncan asked if we had a recent example, but quite a few of those examples that you covered off, Salesh, were quite recent.
Very recent examples, yes. There's one of them was there for, I think it was over the last 6 months we did that deal. So we do chase multi-income properties all the time. Now, Duncan, we do have more examples, but the issue is if I start giving you all the examples, it'll take ages. We do have a lot of examples in terms of development sites, in terms of multi-income sites as well. We do. Now, any other questions you got, Maggie?
Last month, so Duncan says, last month I purchased a multi-income for $870,000 in Hamilton that gets $990 per week rent. I also purchased the neighbouring property of $780,000 with multiple income of $925 per week. There is space to add another 2 dwellings as the site totals 1,700 square metres. Is this an okay deal?
Yeah, it's definitely a good deal, I personally think. Maggie, Then?
Yeah, definitely. Yeah.
I mean, Duncan's purchased an excellent location in Hamilton, and he's purchased smartly because he's got multiple incomes and space to add more dwellings. So
Uh,
knocking off a lot of strategies and just 2 purchases.
and Duncan, if you can, my only recommendation is if you can buy more dwellings before you start developing sites, that would be a better scenario to go through because development's expensive. I can tell you this now because we do work in Rotorua. We've worked out it's 30% more to do work in Rotorua compared to Auckland. So if you're building a house, it costs you 30% more. It's just everything's expensive. At the moment, I need roofers in Rotorua. We can't find any. We're sending our roofers from Auckland. We're sending our electricians from Auckland. We're sending our plumbers from Auckland now. It's just the waiting time to get this guys is unreal. So we're having to send our guys from Auckland. When you send guys from Auckland, you pay for their travel cost, you pay for their hotels, and all of that, and you pay for their tools to be safeguarded. And that's what happens. Any other questions, Maggie?
Do you get a registered valuation done when you purchase every property?
I don't get a registered valuation done prior to buying a property unless I'm really uncertain about the transaction. But normally I don't because normally what I do is I use Property Guru. I study the areas. I know exactly what I'm paying for it. I know what the renovation costs are. Now, obviously, that works for me because I'm an experienced property investor. Now, I don't want suddenly, people out there buying properties without a valuation because I said so. So, very important, if you are uncomfortable, get a valuation done. There's no harm. It's going to cost you $1,200 or $1,300. It will be a good result. Now, I can tell you this: my valuation cost, especially with then ordering our valuations around, our valuations cost between 50 to 60 grand a year. It's just unreal how much we spend on valuations, and we have to do it for banking purposes. We have to spend money on valuations, but on average, 50 to 60 grand a year is what I spend on valuations.
I think
Oh,
to also to elaborate on that, that evaluation is after we've built the dwelling or we've done the renovation to increase the value, so that we could go back to the bank to pull out money and then go back again. So that's where we're within the end of the project is when we're doing that.
yeah, I might.
Yeah, and when you're purchasing, you're doing your own research
Mm,
based on your experience as to what the market value is.
Yeah, and
correct.
half the time I'm sitting with the valuer, sharing comparable sales. They say, "Oh, this is this price," and I said, "No, no, no. Have you seen these sales?" So most of the time, we have a chat before it gets finalized, so that we both are happy before it gets issued.
Now, guys, this I'm going to give you some recommendation. Now, this is obviously my recommendation. It's not Bible, but I'll just talk you through this. First thing is, I always get people saying, "Look, where do you get time, or how do you do this?" And the thing that we notice the most is people do nothing. Act sooner, not later. That's really important. Now, how many people you talk to, they go, "I wish I did this 10 years ago." I wish I bought more properties 10 years ago. You hear this every single day. Maggie Then and I have been presenting for the last 6 years. And, we always had this all the time. From the day one we started presenting. I wish I did this 10 years ago. I wish I bought this 10 years ago. It would have been 300 grand cheaper. I can tell you this now. Property doesn't get any cheaper. I don't know what the media talks about because, shit, I can't find any cheap properties. I mean, if the way the media talks about 30, 40% discount, where are those properties? Because then Maggie and I can't find them. We'd be happy to buy properties that are 40% discount or 30% discount. So the media is in different part of the world, but we can tell you that if you negotiate hard, you might be able to get a good deal. You might be able to, you know. So I was talking to one of the office staff today, and her son's been trying to buy a house for the last 8 weeks. Every time he goes to buy, there's multiple offers in place. He misses out. So it's starting to take off. And it reminds me of 2011 and 12 when the market was just taking off. And in 2014, the prices were going up by 50 to 100 grand a month. It happened.
Yes.
Like people would buy properties for 400 grand and a week later they sell it for 450. And then a week later, someone else will sell it for 500. You know? So this reminds me of 2011 and 12 coming in now, where there's a lot of multiple offers. But then what we're going to see next is prices going up. And that's coming. And I'm telling you, the cost of building is expensive. It's expensive out of Auckland. It's way more expensive out of Auckland. It doesn't get any cheaper. So, and the other thing I hear a lot is, people don't have time. Well, don't use lack of time, or fear as an excuse. Right? If you want to know about time, just look at your screen time on your phone, on your daily usage. They'll tell you how many times, how many hours you look at your phone, and that's what it is. So don't use time as a lack of as an issue. If you do properties, you kind of have to be on it 7 days a week. It becomes a hobby naturally to open your emails and read about properties or what work needs to be done, and draw yourself a timeline with targets. At the age of 26, I drew myself a timeline that at 36 I'm going to be retired with 10 properties. And when I was drawing that timeline at 26, I said to myself, why can't I have the 10 properties now? It was just changing your mindset, and that's what I did. I changed my mindset and I started buying things aggressively and negotiating hard. And again, coming back to surrounding yourself with right people. Always surround yourself with doing people who do properties. It's like if you're a tennis player, you surround yourself with soccer players. You get nowhere, right? Because, Ben knows that. 'Cause he tried to,
Picking the wrong ball.
yeah. So always surround yourself with right people, surround yourself with guys who do properties. We are business accountants, we are property accountants as well. And the kind of clients we attract are mum and dad who are property investors or business owners who use their profit to invest in properties. And I can tell you this again and again and again, 95% of our client base are multimillionaires because they use their money and invest in properties. Maggie's a client of GRA. She started off as a client of GRA, right, Maggie?
Yes.
Yeah, in 2015 with 300 grand as working capital going in, she's a multimillionaire now. But remember, multimillionaire doesn't change your lifestyle or anything. It just gives you that comfort in life about money. If Maggie started blowing $100,000 a year, I can tell you she won't be able to finish her money before she dies. So the long way to.
Well, I hope I live long enough, longer than that, Salesh.
Well, that's 40 years, Maggie.
Mm.
So, so I'm just saying, it's you started just blowing 100 grand a year, you can't. But what I'm just trying to get to the point is, gives you the comfort, you know, it gives you the comfort in life. And what happens is, even if Maggie does start blowing 100 grand a year, she does have assets that are going to go up in value. Assets always go up in value. You got to remember that long term, they go up in value. Again, think long term when it comes to property, guys. You can't think short term. 7 to 10 years is your minimum you got to think, right? If we can think 45 years about our superannuation, 7 to 10 years is nothing when compared to property investing. And again, invest in the right kind of properties. Now, guys, this is a roadmap that we present all the time on, and we get you to start thinking and looking at this roadmap. You work out where you are now in life. What have you got? You might have too much debt. So you might have to sell some assets down and free up some cash, or you might have to work harder and pay off those bad debts away. You might have that. Work out where you are, work out where you want to be. So work out where you want to be in 7 to 10 years. If you're in your late 40s or early 50s, the chances are in the next 7 to 10 years you're going to be a grandparent. That's what's going to happen. So those are some of the things you have to think of. And how do I get ahead? Or you're in your 30s or you're 25. In the next 10 years, you're going to probably get married and have kids. So you start investing now to set yourself up for the next 7 to 10 years. We do have a software called WealthSuite. WealthSuite is a software you can analyze deals and helps you, which is a great software because once you go on WealthSuite, you put a deal, Maggie and Then can go in there and have a look at it for you. And if they don't like your numbers, they'll make changes and they'll tell you why your numbers are incorrect or correct. You get the right knowledge behind you. So we give you right knowledge through property school and development school. Now, if you haven't done property school, please don't do development school because it's hard. So I suggest you do property school first. And the reason you want to do property school is because you want to get access to the supply chain of people you should be using when it comes to property investing. Now, you get a strategy put in place. What are you after? Do you want to trade or do you want to hold? And that's what you decide. And then you obviously work on that strategy. Once you have a strategy in place, let's say you decide to do invest and that's hold or trade, you get the structures set up. The structures need to be set up before you get your pre-approval. Because once you get your pre-approval in your name, the banks actually hate it when you go back and say, I want the debt to be in this company. They get you to apply for everything again. They go, no, you got to reapply under the company. So once the structure's in place, we apply for finance with Chris Pedersen or one of your mortgage brokers, whoever you're using, and you will meet our mortgage brokers through property school as well. And anyway, if you wanted to get hold of them, they're Chris Pedersen Mortgages. If you don't have the details, feel free to email Amy and she'll sort that out. So once your funding is in place, then you go and buy the right property. Before you buy the right property, obviously feel free to call Maggie and Then. Sorry, it's not free. They're on an hourly rate. I take that back.
You're giving everything away today.
No, but look, I mean, if you call Maggie and Then for 5 minutes, I'm sure they'll give that away for free. But if it's more than 5 minutes, because what you got to remember is when you're buying a property, for someone like Maggie or Then to look at it, they have to start from start. They have to look at the property. They have to do CMA. They have to go, okay, well, are you paying the right price? Are you paying too much? You're paying too low, or the property is on a steep hill, or the property's too old. So they need to go from start. So it can take 90 minutes to give you an opinion or an answer what to do. So it's very important. Now, Maggie and Then, they're not expensive people. Accountants are expensive, but at GRA, we're not expensive. But normally Maggie and Then are $250 an hour plus GST. Um, and that's value for money because the best thing they can do is look at it and give you some opinions and hold your hands. And if you don't like what you're hearing, you can cancel the contract. Simple as that. Okay, so I'm just going to move to the next slide. Sorry, it just takes a while to. Maggie, you want to talk about property school?
Yeah, so we have a new live property school that's starting on the 6th of August. So it's going to be delivered online. You just join in the Zoom webinar from home or wherever you happen to be. But it's going to be delivered live primarily by Matthew Gilligan and various other expert presenters that will cover their specific topics. And of course, myself and Than and Salesh will be involved presenting on certain areas as well. So it's going to be delivered live. You'll be able to ask questions each evening as we go. Once, could we just have the next slide, please, Than? Once a week on a Wednesday starting 6th of August and will run for about 7 or 8 weeks. Sometimes we have additional information and do a bonus extra week. So once a week each evening you'll join in. They're going to be recorded, so if you're not available that night, you can just watch the recording afterwards and submit any questions in writing, and then the appropriate person will get back to you about those. During property school, you can also use Wealth Suite, which is a great tool that Salesh talked a little bit about before. It lets you put in all your current financial details to show you where you are, so your assets and debts and income and things, and then you get to put in what you'd like, so your goals. I'd like a rental property or a home, a holiday home or whatever it may be, and it'll do a gap analysis for you, and then you can plug in proposed purchases into that and see if they help you close that gap or not. So it's quite a clever tool. We've got a QR code that you can use to join. It'll automatically apply that $100 discount for enrollment at $495. And if you're an existing GRA client, there's also a link to a 50% discount off the normal price of $595. I believe. And as I said, the modules will be recorded, so you get access for 12 months and you can rewatch all of school or whichever topics you want to go over again or refresh.
Yeah.
Have I missed anything?
No, you've covered everything. And then if you scan this QR code, isn't it, to enroll?
Mm-hmm.
Isn't it, Maggie? Is that how it works?
Yes, so that's the QR code to enroll at property school with the $100 discount.
So guys, if you scan the code and you sign up for property school, even if you pay the full price, we'll send your surplus money back. It's happened before, so don't worry about that. And if you are a GRA client, you do get a 50% discount. Obviously, that's for the old property school, and you get access to the new property school, like Maggie has said. Now, this property school is extremely informative. I mean, you got to remember, we've spent 20 years creating this massive bunch of supply chain, which we handed over to you at property school, And you got to remember, we've used these people and we've got the right outcome. So you don't need to reinvent the wheel. You don't need to go and try new people. You use the people that've done it. Like I said, all three of us are property investors, and we are experienced property investors. It's very hard to come across people who are experienced property investors and they keep doing this in and out every single day. I love doing it. That's why I'm here. I never moan about presenting, right, Maggie and Then? And I always talk to people about property investments, and I say anyone that's young coming along, I'm saying, man, if I could go back in my life at 21 or 20 years old, I'd risk everything. I'd put everything on the line and just buy cash flow positive properties. I'll just chase them left, right, and center. Now, guys, this is a very important website, so feel free to take a photo as well. You don't need my permission to take photos, so you can take it anytime. But here's Initia is a company that we work with at GRA. Please get them to check your property insurance. They offer you really good price on insurance premiums, and also you need to insure your properties correctly. So if you bought an investment property 10 years ago and your building is only insured for 400 grand, please get Initia to check it and work with them, because you replacement, including your house and your retaining wall and taking all the rubbish away if the house catches fire, touch it doesn't, it could be 700-800 grand, right? And if you're only insured for 400 grand, the insurance company will give you 400 grand and walk away. So please ensure you have the right insurance in place. And Initia is a company that I'll recommend. Now, the other thing that I'm going to mention a lot is personal insurance. Very important, guys. Get your personal health insurance in place. Get health insurance on your kids, right? And if you need some special cares, you'll have health insurance in place that protects you. Get your income protection sorted, get your life insurance sorted. We use a company called riskdirect.co.nz. So if you go in there and you obviously get a hold of Steve Monroe or Sam, they can help you review your affairs. They cannot force sell you anything because they are part of FMA. So they're not allowed to force you. They can review and give opinions, and it's up to you if you want to make changes or not. It's all free of charge. So get in there and get your personal life insurance sorted. I can tell you this now. I have health insurance, and last year, my family, we used $17,000 of health insurance because my son suffers from eczema. So we have to use health insurance all the time. He's probably got 1 to 2 specialists seeing him every month. So it's not cheap, and it's not easy to get an appointment with a health specialist. But if you have the right insurance in place, because you're being referred from an insurance company, they see you ASAP. As soon as possible, they can get you in there. They see you. So very important, guys. Get your health insurance sorted. Take a photo of this website and get your insurance sorted. Even on your family home, even on your business, look at the insurance and make sure you've got the right cover in place. Now, guys, we're just about to finish, so bring those questions. We want as many questions as you can. So, Maggie, is there any more questions? But if you...
Yes, we do. We have got some more. We'd like the QR code for Property School popped back up. So that QR code is for other assistance.
So this is the QR code for Property School.
Property School, yeah.
Yeah.
And then we could pop the other one up after a little while. Which area or town would you recommend for good cash flow positive properties?
Yeah, that's an extremely good question. So look, in Auckland, I've seen some good cash flow properties popping up. In fact, one of our staff last week bought a property in Ranui. So he paid $924,000 for 2 dwellings on 1,000 square meters, and it's rented at $1,300 a week. And that's a bloody good buy, because I can tell you, Then and I are on sites every day. We can't build 2 3-bedroom houses for 900 grand. We can't do that. So he bought 2 houses, really good condition, doesn't need any renovation work, and on 1,000 square meters. So he bought that in Auckland. And I said to him, man, if I found that property, I'd have bought it. So like I said to you, I've seen my staff here buy properties. I've seen our clients buy properties like that every day. So the places I find good cash flow investment returns at the moment is Auckland, Hamilton, Rotorua, Whangarei. All these places are taking off, and I see really good investments. The other one that I've seen really good cash flow is Queenstown. they've just got major shortage of properties and the prices keep going up in Queenstown. So I've seen that as well.
Yeah, and as I'm having a little look around to see if there's anything I'm interested in, I've seen cash flow positive property in Auckland and also in regional towns. So it's certainly around. Right. Next question. How can you guys help? Are you helping find properties, and how much does it cost to find one good property? Well, we're not property finders. We just give advice and help people find their own properties.
Yeah.
Anything to add to that, guys?
And obviously when Maggie and Than will help you in terms of a property that you really want to buy, they charge 250 plus GST an hour. So like if they spend half an hour, you'll just get an invoice for half an hour. But it's no harm in taking a second opinion. Just to run some numbers through and all of that. So, and Maggie and Than will look at what the comparatives are, and they'll probably, get into more details as well than you would.
I think the key thing is that we're supporting people in their own search for their property that they're interested in purchasing. We're not connecting people with good deals. After all, if we find a good deal, we buy it ourselves.
Well, and also we don't promote any sort of investor or property developer that you should be buying from. We don't do that. That's not our business.
Yeah. Right, I'm going to leave out the business names from this one, perhaps, unless Salesh you wanted to name them, but we're asked, what is the difference over 10 to 15 years with a strategy like yours compared to, and there's a couple of businesses named here, they seem to swear by new build, negatively geared properties with a forecast of creating a nest egg to retire on. Would a person potentially end up in a similar situation long-term with GRA versus these other companies, but not having to negatively gear for several years? I can't seem to see the advantage of the negative gearing situation.
I just want to come back to negative gearing. Look, guys, you just need to be careful if you can afford or not negative gearing, and if you're a normal mum and dad, say you're normal school teachers, right? And you're earning $120,000 each, you cannot afford to have negative gearing properties. It just ruins you financially, so be very careful. Like I've mentioned in my presentation, I chase cash flow investing, I chase land bank investing, and things like that. So that's my opinion, right? I'm not a financial advisor, so I just want to make that clear again. I chase and look at Maggie and Than. None of them have cash flow negative gearing properties. They have properties that break even, or they have properties that give them enough cash flow to pay a mortgage as well. So you need to be careful. You need to analyze your own affairs in terms of that. However, if you do get to buy a townhouse, right, that's well discounted, like really say 30-40% discounted, and it's cash flow positive or break even, then those numbers work. But again, it comes to your personal choices and your personal affairs. If you can afford negative gearing, well, then it's totally up to you. But we are very cashed, positive, focused business here. We believe in making money. That's who we are.
Yeah, and doing so right from the beginning, so not having to wait for however many years for a negative property to turn positive by itself. Yeah,
Exactly. So if you look at, if you watch us present earlier, we talked about instant equity. That's very important. But yeah, I probably won't say any further because there's a lot of people out there. They're my mates. So
I think it's important to note too that for most people, you would soon be unable to make any further purchases if you're buying negatively geared property. So depending on your personal or business income sources, you could only support so many properties and qualify for borrowing for them if they're not making a positive return.
yeah, and yeah, exactly. So got to watch that.
Yeah. How do you find a joint venture partner?
So another good question here. So, see, years and years ago, when I got into property investing and I was running out of money or serviceability, what I did was, you go through and write a bunch of people you can talk to, and Maggie and Then were in there, but they decided not to do a JV with me. So,
I
but
don't
you,
remember being asked, Salesh.
I know, I've got to recall that email.
so what you do is basically write a list of people that you could do business with. You catch up with them and say, look, I want to buy into properties. I've got the deposit, but I don't have serviceability. Can we team up? It could be your workmates. It could be your best friends. That's what you do. And so that's where you start from and find joint ventures. And you start going to some of the property events and learning stuff. There could be property events you go to and learn nothing. And then suddenly you go to one property event, you figured out what to do. Like what I've explained today and what Maggie and Then have explained, there's a lot of meaning and experience in there. Everything we say that works at certain point and level. But, find yourself a joint venture, look at your family members, look at your friends and anyone with good income or good equity and see what you can do with them. But whatever you do, make sure if you say you're going to deliver with a joint venture, you discuss your task and what you're trying to achieve. Really important, guys. You don't want to disappoint your joint venture partners.
So Sunny is currently developing new builds and putting on rent in Auckland. Would you recommend any other city which provides better yields and capital gain?
So remember, when you develop properties, your capital gains is created based on what you bought the land for and what are you building on it, right? If you overcapitalize, there's no capital gain. Your development. If you suddenly go to, for example, you go into Manirewa and you build Taj Mahals in there, really high spec. I could see it smiling. Really
Nothing wrong
high.
with Taj Mahal in Manariwa.
No, but if you start building really high spec townhouses, well, in Manirewa, a 3-bedroom will sell for 900. That's high end. But in Auckland City, it might sell for 2 million. So you can't build those kind of houses in Manirewa because you could probably end up building a cheaper house in Manirewa and still get 900. So you can't overcapitalize your development. Now, for me, the capital gain is in Auckland. It's in Rotorua. It's in Hamilton. It's in Whangarei. Whangarei's got a major housing crisis, so definitely Whangarei is one place that I'd be looking at. I think they've got about 20,000 shortage of houses in Whangarei at the moment, and they can't fix that problem anytime soon. You've also got to remember is we got 1,500 refugees coming a year. We got immigrants coming in. Suddenly we're going to have a lot of pressure on our housing, and that's a lot of family to house. And so once we stop building and slow down in building, in a couple of years' time, we're going to have a lot of pressure and rent's going to come up.
And if there's a lot of tourists, then properties that are in the rental pool get pulled out and turned into Airbnbs.
Yeah, absolutely. Absolutely.
And people want to either buy their own or not share with family anymore or friends, for example, once they feel more financially secure and the economy improves. And so it soaks up more houses, doesn't it? And you end up with a rental shortage again.
Yeah.
How do you invest across islands, e.g. live down south, want to invest up north or vice versa?
Oh, I thought islands meaning like in the islands,
No, North Island versus South Island.
Oh, right. Okay. I started thinking about like Rarotonga and that. Okay. Well, thank you. Look, I mean, people in South Island do invest in North Island. They just come around, they get a good real estate agent, they buy a good property, they put a rental manager in, and then they disappear back to South. And same thing if you're up here, a lot of Aucklanders buy in South Island at the moment because they can't believe how cheap the properties are in Christchurch. So, that a lot of Aucklanders are down there. A lot of Aucklanders are buying in Christchurch, in Rotorua, those and up north in Whangarei. I can tell you this now. The auction rooms are busy by phone bidders, and as soon as you go on phone bidders on, they're Aucklanders. Because Aucklanders won't even drive to South Auckland. They'll go on a phone bid. If they're buying a property from central to south, that's a 15-kilometer drive. They'll just do phone bid and watch it live. Yeah.
If you're not familiar with a town, you might make a trip and spend a weekend or a few days there or whatever, getting to know the different suburbs and talking to agents and property managers and getting a good feel for the place. But otherwise, we do all the assessments, analysis of a property online. You can offer on a property or attend auctions remotely.
I guess the
And
important
find yourself tradesmen if you need them, without having to be there in person.
part is, I guess, is the research, get to know the area that you want to invest, know what the good streets are, not so good streets, so that, your assets, what you're buying is, bulletproof.
Exactly. Really important. Now, guys, we're going to wrap up shortly. So if you got any more questions, keep it coming. You got to remember here, we got, about $1,000 an hour free resources available. So feel free to abuse us before we disappear. Now, if you do want a meeting with someone at GRA, please click on this QR code and they'll take you to one of our forms that's sitting at the back, and fill that out and we'll book you an appointment. Like I said, anyone that fills out the form will go into a draw to win property school for the next 12 months. That's including the old property school and the new one. And also, if you do fill that out, you'll get a free book. Only reason we're giving it away, because I want you to understand about properties. I'm all here to help you into property investing, and all of us here, Maggie and Then as well. We all as a family believe in property investing. And hopefully we'll get to see you one day face to face or a meeting in our office. But if you've got no more questions, then I better say good night and disappear.
Wonderful. Thanks, guys.
Thank
Thank
you.
you.
See
Good
you.
night.
Bye. Bye.